Hello, this is Mike with NetPicks.com and the Options Mastery Program. So in today's video, I want to do a really quick walkthrough of a trade that we just closed out here today on USO. This is an oil ETF that we've tracked now for a number of months. Really, for me personally, I've traded it for the last couple of years. So really unique product in that, a lot of people want access to the energy markets. A lot of people track the crude oil futures markets. I know it's a very popular market for day traders. Well, on the options side of things, the options on futures aren't always very liquid. It can be tricky products to trade. So one of the ways that you can get access to the price of crude oil on the futures side is to trade USO because they are directly correlated. So if you see the futures rise, you're going to see USO rise along with it and vice versa. So it's a really nice product. It's a pretty liquid product. I mean, I've had no issues getting filled on any trades that I want to take with any type of size. So it's a pretty nice product to have on your watch list. So let's take a look at one of the trades that we closed out. In a previous video, we talked about playing USO to the upside, and we did so back in September. We actually sold a put spread, and we played the initial bounce to the upside. So you can kind of see here, let me zoom in a little bit. You can see going back into September, we did get a move to the upside. And most recently, as we head into October, we have seen a little bit of a bounce. That was enough to close out of our put spread. So by selling a put spread, that is a bullish position. We sold the put spread originally for 38 cents. We bought it back for 11 cents, and that booked about $27 of profit per spread. Okay. Keep in mind, when you put on these spreads, we're talking about risking less than $100 per spread. So you can put this on multiple times with very little risk. But that's not the trade we're here to talk about today. The second trade type that we put on was an iron condor. And the reason I've been talking so much lately about iron condors, they're very nice trades to have in a market that's either choppy at the moment or you anticipate getting into a choppy pattern. Okay, where there's a lot of noise, a lot of back and forth, but we really don't go anywhere. Okay, so it's a very handy tool, a very handy trade type to have access to, but a lot of people ignore it because they get intimidated by it, just purely by the name, and then when you start to dive into it, you see that there's 4 options as part of one trade, and it can be a little overwhelming initially. Well, throughout our options mastery course, we teach on this setup type all the time because when you really start to break it down to its components, it's a very simple trade to take. Even if there's 4 different options, there's 4 different legs to the trade. Okay, it's actually very simple in setting it up, and it's very simple in what we're looking for it to do. So let's take a look at the trade that we put on and the trade that we closed here today. So going back into September, it was mid-September when we originally looked at putting on this trade. So an iron condor, all it simply is selling a call spread and selling a put spread both out of the money at the same time. We're looking to do it in the same expiration month. Okay, so we went out into the October options. Those are actually expiring this week. That's why we had to take action. It was actually we were actually fortunate to be able to close out of the trade today with a really nice profit. So when we looked at this chart, and let me zoom out a little bit so we can see the big picture. The reason I looked at the iron condor, I often get questions, why do I choose certain trades over other trades? So why did I choose an iron condor as opposed to playing just a long call to try to play the bounce to the upside? Well, when I look at this chart, number one, I saw the big move to the downside during the summer months. Okay, you got into June, you got into July and August, and we saw a pretty nasty move to the downside in the price of oil. Okay, so I was immediately looking at this saying, okay, we're probably a little extended. So I wanted to put on some trades that would benefit from USO either getting into a sideways range. If we start to establish, range, if we try to base a little bit, I wanted to put on a trade that would benefit from that or a potential bounce to the upside. So I was essentially looking at the chart saying, okay, I'm going to take a contrarian view. I'm going to say, you know what, the damage has been done to the downside. Let's try to play the opposite. Let's try to play a bounce higher or a sideways move. So that's why I looked at an iron condor as one of those trade types. So what I looked at is once we started to bounce higher, then we started to get into a range. So we got into the trade right in here. Okay, where I'm circling let me go ahead and mark that. Let's go ahead and see if we can get it marked. Okay. So what we had seen, we saw the big move to the downside. I waited to put on the iron condor until we saw the initial bounce, and then we started to establish a little bit of a range in here. So that's a perfect price pattern for us to look at for an iron condor, because we've already seen moves in both directions, and now we're, as expected, the way that markets typically move, when we do get choppy, you can start to base, you can start to consolidate for an extended stretch of time. So I looked at that and I said, okay, let's look at an iron condor here, and let's try to box the price in. Let's try to sell out of the money call spread up above here. Let's try to sell an out of the money put spread down below. And that's going to create what we call our profit window. So let's go over to the trade page here. And let's take a look at what I was doing. All right, so USO, pull that up. And let's go ahead and set this to 10 strikes. All right, so what we decided to do based on that chart, I just walked you through the reasoning for looking to put on the trade. So I went into the options page and I decided to try to find some spreads that would meet our criteria. So the trade that we ended up putting on was out in the October monthlies, and we sold the 15.5, 16.5 call spread. So I'm going to right click on the 15.5 call. I'm going to go to sell, and I'm going to go to iron condor. And down at the bottom, you're going to see a trade pull up with 4 different options. Okay, so we'll walk through each individual leg there in just a second. So what we did, I'm going to switch these strikes here so you can see the exact trade. I'm going to switch this to 16.5, and I'm going to switch the put side to 14.13. All right. So let's take a look at the call side first. We sold the 15.5 call, okay? And at the same time, we bought the 16.5 call. I personally do not like to sell naked options. I like to be in a risk-defined position. So the nice part about an iron condor, when you get into a trade, you know exactly what your maximum profit could be. You know exactly what your worst-case loss would be if the trade went against you. So I like that feature. Okay, I know what to expect right up front. Now, am I giving up some profit potential by making it a risk-defined position? Yes. You would make more money if you just sold naked options, but it's also going to tie up more capital to put that type of a trade on. So I prefer the risk-defined trade. It allows me to lower the cost of the trade, even though it's going to leave me with a smaller profit. So by selling the 15.5 call, that creates the upper boundary of my iron condor. When we put this trade on, we're trying to create a profit window, and the upper end of that profit window is the short strike on the call side. Now we can sweeten that a little bit more. We can push that break-even point out a little bit farther, because when I put this trade on, I collected 52 cents. So my break-even point was actually taking the short strike, that 15.5 call, and I added on 52 cents to that. So my break-even point was actually up around 16, just above 16. Okay. Now on the downside, I sold the 14 put and bought the 13 put to make it hedged on the downside also. Okay, so that 14 put becomes my break-even point on the downside, but remember, I factor in that 52-cent credit that we put the trade on for originally. So my actual break-even point on the downside was down around the 13.50, just below 13.50. So now between 13.50 and just over 16, as long as price action stays inside of that window, I make money. I don't care if it goes up. I don't care if it goes down. I don't care if it goes sideways. Okay, the whole point of this trade is that it stays inside of the profit window, and we're hoping that we can close it out by buying it back cheaper. We're hoping the options lose value. How do they lose value? Well, if we stay inside of a range, so we could potentially make money in all 3 market directions. If it goes slightly higher, slightly lower, or sideways, as long as it's inside of our profit window, we make money. We also make money if time decay adds up. We put this trade back on in the middle of September, so we've held it now, almost a month. Okay, so that whole time, that time decay, every day that we hold the position, the time decay is adding up. It's working in our favor. Okay, so that was a nice feature. Okay, we also make money if volatility decreases. If we take a look at the implied volatility, let's go ahead and scroll down here. You'll see the IV percentiles at 49. When we put this trade on, it was way higher than this. Okay, it was way above 50, but if I remember correctly, I want to say the IV was up in the 80 range. Okay, so this whole time that we followed the trade, the time decay has added up and the volatility has gotten cheaper. When volatility gets cheaper, the options get cheaper. That's exactly what we want to have happen on the Iron Condor. Okay, so the reason this trade is great, we have 5 potential ways of being profitable. All 3 market directions potentially, time decay adding up, and volatility decreasing. So this is why I like to put on these types of trades. When you buy a call, if you're trying to play a bullish bounce off of an oversold level, if you buy a call option, that's one way of doing it, but you need everything to work out perfectly in your favor. You need to be right on market direction. You need to be right on timing. That trade needs to happen quickly, otherwise the time decay is going to add up. When you buy an option, you need volatility to increase. Okay, when we put this trade on, we already felt that volatility was high. Okay, so if volatility is high, I'd rather put on a position that would benefit if volatility does contract. So instead of putting on a trade with a long call, where you have to have everything line up perfectly, we put on a trade where we have 5 different ways of being profitable. Any combination of those 5, and we're working out, and that trade's going to work out great for us. So if we go back over to the chart here real quick, we put the trade on here. Notice what price action did. It went down briefly, and let's go ahead and get some of those indicators out of there so it's a little bit easier to see. See if that helps us out. There we go. Okay, so we put the trade on here. You can see that once we put the trade on, we headed lower, then we bounced back higher. Okay, we were all over the place. Okay, I didn't care, because as long as we closed inside of our profit window, let's go ahead and get some lines on here marking the outer edge of our profit window. So the whole time what I was looking at here, these aren't going to be to the penny, but they're going to be pretty close. So I didn't care what USO did. From the time I put the trade on, I didn't care if it headed higher, lower, or sideways, as long as it stayed inside of our profit window. And that's exactly what happened. Okay, now did I have some crystal ball to look into to see that a USO was going to get choppy? No. What I did is I looked at the chart and I said, okay, we're oversold. Okay, we've seen an incredible move to the downside. Just because we saw that does not mean I jump right into the trade. I waited for the price action to initially bounce, and then the choppy sideways pattern developed. Okay, so it was the perfect pattern for an Iron Condor. So if we go back over to the trade page, you can actually see that this one's trading for 31 cents. It was actually trading as low as 13 cents earlier. We actually closed it out for 15 cents. So when we originally put the trade on, we collected 52 cents of premium. We just bought it back for 15 cents. Okay, that gave us 37 cents of profit per Iron Condor, or $37 per spread. Now, it doesn't sound like a ton of money, right? Okay, we only tied up $48 of capital for every spread that we put on. You could put that trade on 10 times and still have less than $500 of capital at work. Okay, that's the powerful part about an Iron Condor. Okay, am I looking for a home run trade here? No. Am I looking for that 500% return that you see advertised all the time? No. Because in this case, when you put on an Iron Condor, it's not a trade that you're expecting a huge return from. Okay, we're putting on this trade to try to scratch out a profit if we're anticipating a stock or an ETF getting into a sideways choppy pattern. This is a way that when you trade options, I trade the same products all the time. If I had a big directional bias on USO, if I expected a huge move to the upside or downside, there's much better strategies out there. I could go ahead and play a vertical spread, or just a long call, long put. But in this case, I was trying to put on a trade that would benefit from this market doing absolutely nothing. You can't say that about any other product out there. You can't make this type of a trade, buying or selling futures contracts. Okay, but because we're trading options, there's always something for us to do. Okay, a lot of times people get stuck when the market gets choppy. They get stuck, trying to play breakout moves, and you get false breakouts in both directions, and in the end, you're just spinning your wheels. By putting on this trade, we are actually able to scratch out a profit. Okay, $37 per spread. And what did the market do? Go back to that chart. The market did absolutely nothing. It moved straight sideways. Okay, that's the cool part about this trade. So essentially, when you're putting on an iron condor, you're expecting more of a neutral move, and the trade is put on by selling an out of the money call spread and an out of the money put spread at the same time. Okay, that's all it is. Forget about the complex name. Okay, I wish we could change some of these names. Everybody, wants to come up with these creative names that sound really impressive, and unfortunately, they can be intimidating for some people. Okay, all we're trying to do here is create a profit window. Once we create that profit window, we just want price action to stay inside of that. Okay, so it's a very, very useful trade type, especially when you expect a period of chop. Okay, now ideally, you'd want to put these trades on in periods of higher volatility. That allows you to collect more premium, and we were able to do just that. So everything worked out really, really well for us. So just close this trade out today. And now we'll, depending on our outlook for USO, we could potentially sell another iron condor out in the November options. Just depends on whether we're bullish, bearish, or neutral on USO. And that's something that we can talk about in future videos here in the coming days. Okay, so hopefully that helped out. As always, if you have any questions at all, feel free to send me an email, mike@netpicks.com. I really encourage you to expand your playbook, because these are the types of trades that are really, really fun. When you start to see your profit increase when the market does absolutely nothing, that's when trading gets really powerful. So, dive in, do a little bit more research on this the trade type, and I think it'll really pay off in the end. So I'm going to wrap this video up here, and I'll be back here in the next couple days with our midweek recap.